Hi everybody, Thomas at Rebel Income here. With the S&P 500 breaking to a new set of highs over the last couple of weeks, it's unusual to see one of the stocks in that index doing just the opposite. Stocks in the index are leaders in their sectors and their industries, so it's also just as unusual to see an industry's 600-pound gorilla moving in the opposite direction of its sector and industry brethren. It's strange, but not impossible. And Nike is a perfect example right now. One of the most recognizable brands across the globe. You wouldn't expect to hear that this stock has fallen all the way to its own bear market levels when the S&P 500 is rallying and even the consumer discretionary sector is also near its yearly highs. But it's true. Now that sounds pretty scary for bullish growth-oriented investors. But for bargain hunters like me, that news is a reason to sit up and pay more attention. Is Nike's bear market status an opportunity to buy a terrific company at an attractive discount? Or is there something more serious going on? Let's take a look and try to find out. Before we dive into the details, I want to invite you to check out my Rebel Income Patreon page. I publish daily exclusive access content on this page, from stock reports detailing my analysis in search of the trades I publish for my trade alerts, to lists of underpriced dividend-paying stocks. You can also sign up to participate in my weekly live webinar, where I discuss current market conditions while the market is open in a dynamic group learning environment. You'll find the link to my Patreon page in the description area of this video. Take a look and sign up for a 7-day free trial of any of my patron levels. I know you'll find something that you'll be able to use in your own trades. Over the last 12 months, Nike has seen some impressive improvements in their fundamental metrics. Let's start with free cash flow. You can see that a year ago, free cash flow was about $3.8 billion and has since increased to $6.3 billion as of the most recent report. That also marks an increase from the last quarter when free cash flow was about $4.4 billion. In addition, the company's cash and liquidity has been also strengthening over the last 9 months. A year ago, this number was $7.4 billion, and then it declined to a little under $6.2 billion as of the next earnings announcement. But from that point, we've seen that number go back up again to its current level at $8.96 billion. That implies not only that cash is improving, but it also gives the company a lot more financial flexibility to work with in terms of returning value to shareholders, pursuing acquisitions, and finding other ways to invest in its business. Long-term debt, on the other hand, has been pretty stable over the last year, sitting at $8.9 billion 12 months ago, and practically the same level in the most recent quarter. All of these are generally positive indicators that are supported by the company's overall operating profile. I like to measure this by comparing a company's net income to its revenues. Over the last year, this number for Nike was pretty healthy at 10.14%. In the most recent quarter, however, this number increased to 11.79%. That's a little over 1%, which may not sound especially remarkable in and of itself, but the increase is useful and important to consider, especially when you think about the larger macroeconomic environment with a lot of inflationary pressures and concerns in place right now. When you consider these strengths in net income and free cash flow, as well as cash and liquid assets, there's certainly no question about the company's ability to service their debt. My preference with Rebel Income is to focus on dividend-paying stocks. So let's take a look at Nike and see what their dividend looks like. With the stock sitting at around $92 per share right now, and their dividend at $1.48 per share, Nike's dividend translates to a conservative annualized dividend yield of 1.61%. I'm not a high dividend yield chaser, so the fact that they pay a dividend is more interesting and more important to me than exactly how high this number is. Another thing that is of concern and that I do pay attention to is how sustainable a company's dividend is. So let's take a look at that. This chart shows the company's pattern of dividend payouts over the last 5 years, along with its earnings per share. The number in the top right corner is the annual dividend payout per share, while the number in the top left gives us the total earnings per share over the trailing 12-month period. We can see a clear pattern of increase in the last quarter of every year since 2019. That's generally a solid and positive indication in and of itself that the company's profitability is on solid footing. This is also supported by comparing the dividend payout to earnings per share. This is a measurement that is generally called the dividend payout ratio. The math for calculating a dividend payout ratio is very simple. We simply take the dividend payout per share of $1.48 and divide it by $3.61. That translates to 0.409, or roughly 41%. This means that the company is paying about 41% of their annual earnings per share right now to service their dividend. This is a little bit higher than a lot of companies will do, but as a general rule, I look for the dividend payout ratio to be 50% or less in order to be considered a high quality dividend. So for Nike, this is definitely below that point. With all that in mind, let's take a look at the company's price action over the last year. We can see that the stock has been following a general downward trend for most of the year, save for a temporary rally in 2023 that ran from October until just before Christmas. The stock peaked at about $122.50 per share and then began a very clear, again, downward trend that is now seeing the stock down at its current level at about $92 per share. This downward trend was precipitated and has been extended by two overnight gaps following the company's last two earnings reports that have both combined to keep bearish pressure on the stock pretty high right now. Now, over the last week, the stock has been hovering in a pretty narrow range following the most recent earnings report, with current support sitting right at around $92 per share and immediate resistance at about $95. With all of this in mind, the question is, if the stock were to reverse its current bearish momentum and go higher, how high could it go? Now, first of all, it would have to break $95, but if it can break that level, where would its next most likely resistance be? In order to try to evaluate this, I like to try to look for previous pivot activity. We can see quite a bit of activity in early February and March at around $98 per share. So if the stock can break above $95, it should find next resistance at around $98. What if $92 as current support doesn't hold? So far, for the last week, it's done a pretty good job of that. But what if it breaks down? How much further could the stock drop? We can see that the stock's 52-week low occurred back in October at around $88 per share. So that gives us our secondary support level. If $92 does not hold, then the next most likely level of support is going to be $88. With all of this in mind, this gives us a way to look at the current technical setup from the perspective of reward to risk. And if you're interested in placing short-term trades with this stock and you're a primarily bullish investor, this is an excellent way to evaluate whether or not you're looking at a stock that's offering enough reward to risk to make a near-term trade worthwhile. Now, in this case, with the stock at around $92, if it can bounce off of support and start to rally, we know that it's going to find first resistance at 95. Let's go ahead and talk about the best case scenario. If the stock can see an increase in buying momentum, how much further could it go up? Well, with next resistance at about $98, that means that total upside in the stock is at about $6 per share from its current price. On the other hand, we're looking at about $4 of downside, which means that the total reward to risk in this stock is about 1.5 to 1. Now, smart technical traders, whether they're talking about trading based on trend analysis or momentum swings, are generally going to be looking for reward to risk ratios of at least 2 to 1 before they're going to be willing to take a trade. That means that from a near-term perspective, Nike isn't offering a very good opportunity right now. But this doesn't really say anything about the other side of the equation that I like to focus on as a value-based investor. And that question revolves around the fact that the company has a lot of interesting fundamental strengths in place. Are those strengths enough to suggest that this downtrend is offering an interesting value-based opportunity? Again, with the stock at around $92 per share, my fair value analysis right now is putting a fair value target price at around $164 per share. That means that Nike right now is offering about 78% of total upside, along with its 1.6% overall dividend that provides a little bit of passive income on top of that long-term upside. Now, if you want to take advantage of this opportunity, that does mean accepting the possibility of some near-term price volatility. The stock is, after all, right now moving in a clearly bearish fashion. But if you're willing to work with that and take a long-term perspective, Nike certainly looks like a very compelling value proposition. Thanks, everybody. I hope you found this to be useful. If you like my content, please go ahead and like this video and subscribe to my channel so you can get notifications each time I publish new content. I'm Thomas at Rebel Income. Talk to you again soon.